Hi. In the previous 6 videos, we illustrated inventory accounting where we had 400 basketballs in beginning inventory. We purchased 200 on January 8th. We purchased 400 on January 19th. So during the month, we had a total of 1,000 available for sale and 450 were sold during the month. Now, we're going to ask the question, well, what happens if we had 1,000 available and we sold 450, but when we do the count, there's not 550 there. Instead, there's 548. We have a physical count discrepancy. So what's required here is we're going to do the adjusting journal entry that's required. First, we'll do it under a periodic inventory system using FIFO. We won't do all 3 cost flow assumptions. We'll just assume FIFO. And then we'll do the journal entry using FIFO, but in a periodic inventory system. Okay, so at this point, I hope that you'll look back, read the book on how this is done, and then we'll illustrate it, work the case, and then come back and see if you got the same thing I did. All right, see you in a moment. All right, welcome back. So this falls into the category of inventory shrinkage. Shrinkage can occur naturally in the production process. For example, in brewing beer, steam occurs. And so certain of the inventory goes off into the ether. It also occurs in retailers, it occurs because of theft. Okay, so let's look at how we account for the 2 balls not accounted for, not present at the end of the month that were expected to be there under a perpetual system. Now, we're assuming FIFO, so the first in, first out was the 400 that we purchased at 25, and then several of the balls we purchased at 28, but there were some left at 28, and then there was the 400 left in the batch we bought for 30. So under FIFO, we assume that 2 of them that are no longer there cost us 28, and we record an inventory shortage expense of 56 and reduce inventory by 56. So essentially what happened here was we had 1,000 available for sale. The cost on those, if you'll recall, was $27,600 total. Now, there was 3 places they could have gone. Sold, 450. Ending inventory, $548, and stolen or lost 2. And so the 27,600, 56 is allocated to stolen, 450 sold, be that same 11,400, And then ending inventory, rather than 16,200, would be 16,144. That's where the 27,600 cost of basketballs available for sale. 11,400 was reported as in ending inventory. I'm sorry, 16,144 in ending inventory. 11,400 sold, and 56 lost. And the sum of that is 27,600. It explains exactly where the inventory went. And that's accounting for the inventory shrinkage under the perpetual system. Now, under the periodic system, here's the thing. Once again, we zero out the balances, just as we did. That's the beginning inventory balance. That's the zeroing out the purchases. The ending inventory, all we know is that there's 548 balls there, and we assign those costs. And so the $56 of inventory shrinkage actually just goes into cost of goods sold rather than being specified as inventory shortage expense. So that's the one thing that's different under the periodic system. We could look back at our sales records and discern that shrinkage was 2, but that may or may not be possible, or may or may not be practical, depending on the number of transactions with the periodic system. So inventory shrinkage under the perpetual system, we knew the amount of the loss. Under the periodic system, it just defaults into cost of goods sold, and we'd have to do a lot more work to determine what was the amount of the inventory that was lost or stolen. And that's how we account for inventory shrinkage loss. Thank you for your attention, and have a great day.